Hello guys, today what we're going to do is we're going to create a portfolio and we're going to discuss diversification, and we're going to do this using Python. I personally prefer R, but as Python is getting more and more popular, I'm going to use Python right now. I want to mention that I'm using a pre-made functions for this video and for other videos most likely that I'm going to make, and I'm not going to discuss them here what they actually do, so please let me know if you need further explanation. I'll make another video. Leave a comment below. Also feel free to like, share, subscribe. This is how you support my channel and I would appreciate it a lot. Alright, so let's begin. The first thing is that you need to install the Yahoo Finance. How you do this is you enter in your command prompt and you enter pip install Yahoo Finance like you install every other package, every other library. Where you can access this terminal, the easiest way is if you're using Anaconda, it's over here. Alright. After that, we import it with pandas, numpy, and this file, and also we're going to create a ticker symbol list. So this is the list of our stocks that we're going to use for today. Okay, and the next thing is that we're creating an empty data frame and we're setting the index to date. I am using this because after that I will use a right join. So as I said, if you need explanation on terms like this and process like this, let me know. So we're using it and we're creating our data frame. Let's see it. Here we go. Now the next thing that we're going to do is to compute returns. Okay, the returns is basically the current moment minus the previous moment divided by the previous moment minus 1. And after that we're going to compute lifetime returns. So to see actually what is the return if we invested in the beginning of 2015 and sold our investment and sell our investment at 13th of April this year. All right, so let's see it. Wow. All right, so here you can see that AMD would have been a great investment. Now keep in mind that to catch this kind of trades is very hard, and usually not a lot of people do so. Keep in mind also that a lot of people use these kind of situations to promote trading. Now, get rich quick schemes are not what we're going to discuss today, but the aim of this channel and this video is to show you how to build a stable portfolio so that you can invest your savings in it, or at least to know what is the practice and what is the terminology behind portfolio building. Well, today we're not discussing terminology, but I think that this is more useful. All right, so the next thing is to analyze the returns, so we can get analyzed returns. Now here I put 252 because I'm using daily data. If you're using monthly data, here you have to put 12, as this is the periods that we have in a year. For example, we have 252 trading days in a year, and we have like 12 months in a year. So it's very important what type of data you're using, what's the data frame. All right, the next thing is that we're going to compute covariance matrix. Now covariance matrix is used to identify risks. Risk is very important. The two aspects of investing is portfolio building is risk and return, and actually how much return you get per unit of risk, how much you pay for your return. Okay. The next thing here, now I'm going to put this in false for now. Okay, so here we get 20 portfolios, 20 portfolio distributions that we can have. We can generate more, but we're not going to do so in this video. Then let's see what are the most efficient portfolio distributions. And there are three types of portfolio distributions that you must know. Now I'm not going to discuss the first type. The first type is maximum shape ratio. This is important portfolio distribution if we have the free risk rate, but as currently we don't have it and it's not a name of this video, I'm not going to discuss it. The next thing that is very important, next type of portfolio, is the global minimum variance portfolio. Now this is the portfolio that contains the minimum variance out of these efficient portfolios. And the next type of portfolio is the equally weighted portfolio. This is basically your investment divided equally between the assets that you're including in this portfolio. So let's visualize them. All right. So the golden dot over here is the equally weighted portfolio, and you can see that it almost lies on our efficient frontier, but it still has a better opportunities. Now the other type of portfolio, the global minimum variance portfolio, is the most left dot out of these, and it's over here. So this is its distribution. It's 85% for Berkshire Hathaway, 10% for Apple, 5% for Microsoft, and almost no investment in AMD. You may ask, well, AMD has the best result in a lifetime. Well, yeah, but the risk behind it is probably larger than this. Sometimes it's better to avoid risk than to gain returns. Actually, most of the time, this is more important. All right, and now you may ask, okay, so let's say that this is the portfolio that we want. What is our expected return? Well, let's compute it. It's 7%. So actually this function gets our weights for the general minimum variance portfolio, and it gets the portfolio return. But let's say that we want a higher return. We're not satisfied with this 7%. Let's say that we want 25% return, all right, using these assets over here. And we basically can reach it, but yeah, we can do it. So let's see. Okay, so this is the weights of the expected 25% portfolio, but it's not, how to say, it's not the less riskier. This is the less risky portfolio. If you're a risk averse person, this is your portfolio. If you are the 25% guy, let's say you want to get 1/4 of your investment per year, this is your portfolio. So the thing is that there is no most efficient portfolio. It really depends on your preferences, the risk that you could take. For me, for example, this is the best portfolio, as I don't like to risk a lot. So this is the portfolio that I would have chosen.